This video is brought to you by Guardio. Stick around to hear more about the discount they're providing to the entire Upper Echelon community. Also, there are only 4 days left to purchase limited edition holiday merchandise and support the channel. Links are down below if you like the shirts. Okay, before diving in, this video is predicated on extensive information that I discussed with and was given by a prominent source in the legal field of securities regulation. To verify authenticity, I was given access to this person's bar number in multiple states. I was allowed to examine prior work history and a series of other benchmarks as well to validate what was being discussed. Having reviewed everything at my disposal, I am confident when I say that this person is not only real, but that the video they have now helped me construct is extremely important. To start with, we need to establish a premise. In the aftermath of FTX, that is the downfall of a multi-billion-dollar crypto exchange/fraud scheme that sent shockwaves through the financial system, in the aftermath of all this, accusations have begun to swirl that regulators were asleep at the wheel, and that the SEC, the Securities and Exchange Commission, led by Gary Gensler, is somehow partially to blame. That idea is not too far off base, but there's quite a bit more to the story. As the tangled web of connections is slowly unraveled, very slowly I might add, information and fallout from this collapse will be processed for months, maybe years into the future, but as the tangled web slowly unravels, bits and pieces of a wider story have begun to take shape. One of those revelations is that Gary Gensler, chairman of the SEC, and Sam Bankman-Fried, former billionaire crypto founder of FTX and Alameda Research, the two companies embroiled in scandal right now, had private Zoom meetings, several of them, in the preceding months before FTX ultimately collapsed. Sources familiar with those meetings have said, in statements to various different media outlets, that FTX was seeking a regulatory monopoly, and that the SEC, under leadership of Gary Gensler, was at least partially open to that discussion. In fact, as the controversy surrounding FTX came to a head, Republican House of Representatives member Tom Emmer took to social media publicly, accusing Gary Gensler of running to the media, while reports to his office indicate that there were back-channel deals taking place, utilizing legal loopholes, to grant FTX a regulatory advantage in the crypto space. Regardless of what the truth actually is, a singular narrative has begun to form, especially on social media, centered on the idea that regulatory agencies were inadequate or deliberately unwilling to regulate FTX, thereby preventing, or at least mitigating, some of this now widespread damage and fallout. Here's the thing though, I believe that narrative is wrong, or at the very least partially incomplete. I believe that there is a massive underlying story at play here, and that FTX has served as a useful incitement event, catalyzing a long-planned governmental takeover of mainstream cryptocurrency. Alright, before going further, I'd like to once again talk about this video's sponsor, which is Guardio. I talk a lot about cybersecurity, proactive defense, and responsible online decision-making lately. A great deal of this hinges on personal awareness and good user practices, but over the course of our online experience, we will always end up, from time to time, in unsafe digital locations. Maybe a compromised website, a bad link in an email, a simple mistake, who knows, but when that does happen, and it will happen, it's good to have something there to pick up the slack. Guardio is a Chrome extension that offers threat tracking and online protection. Browsers, like Chrome, which is an extremely popular one, are a very large part of our digital lives, and Guardio is meant to secure that space because browsers also hold a tremendous amount of our personal information, which can compromise our security. This goes double, by the way, if you're someone who likes to click save passwords or enable all cookies when you surf the web. Browsers very often store banking information, personal details, login credentials, and more. Guardio, unlike traditional threat responses, which will react when you have already been infiltrated or compromised, works proactively to detect threats before they ever reach your computer. And if you click the link down below right now today, you can have a free scan, as well as a 7-day trial of the service. After that, it's $10 per month, but the Upper Echelon community will receive 20% off. Just to make sure I mention this, Guardio blocks 100 times more harmful websites than competitors and blocks 10 times more malicious downloads than any other security tool. Guardio will detect threats before Google and other competitors. By the time a site has been blocked by Google, there's a replacement. That's how these scam sites work, constantly rotating with new versions. And Guardio will once again be the first one to detect them. On a personal note here, I didn't actually know that my own information has been part of a data breach recently. Actually, multiple, but there were a few big ones, including my previous merchandise provider. I didn't know this until using Guardio. For those interested, you can protect up to 5 different family members under one single account, and with over 1 million customers already, Guardio is looking to continue its mission of protecting your browser from online threats. Again, link down below to install, and 20% off for the Upper Echelon community. Big thank you to Guardio for sponsoring the channel. Alright, setting the stage here, we need a couple more key bits of information. First, FTX itself was under legal scrutiny before its final implosion in early November of 2022. United States prosecutors from the Southern District of New York were pursuing an investigation into violations of the Bank Secrecy Act, which is critical to remember moving forward and will tie back in heavily later on. Second, CIA Director William Burns has now publicly acknowledged in early 2022, I believe, that the CIA has a number of different projects focused on cryptocurrency and that they are helping their colleagues in other parts of the US government.
This is something I inherited. My predecessor had started this, but have set in motion a number of different projects focused on cryptocurrency and trying to look at second and third order consequences as well, and then helping with our colleagues in other parts of the US government to provide solid intelligence on what we're seeing as well.
These two factors combined are necessary to establish a foundation that governmental operatives and agencies might not have been asleep at the wheel, but there's more. Crypto, legally speaking, is a capital asset, which may sound meaningless but actually holds a lot of important distinctions. Established by IRS rulings on two separate occasions multiple years ago, crypto was defined as a capital asset or investment property, which carried a certain set of limitations. Such a classification meant, in no uncertain terms, that Bitcoin and other alternative tokens could not be listed on foreign capital exchanges, which would have treated the token as money or legal tender. In truth, there could be some sort of alternative explanation here, but the most likely reason for this is to prevent competition with the US dollar, should the crypto market grow large enough to do so. That's important because it begins to alter the current narrative that regulators were somehow asleep at the wheel. The CIA had ongoing projects in crypto, the SEC had meetings with FTX behind closed doors in the run-up to the eventual disaster, the IRS had ruled that crypto was a capital asset years ago, possibly to prevent competition with the US dollar, and FTX had been under investigation regarding the Bank Secrecy Act in the Southern District of New York. We can say they didn't do enough, or we can say they did the wrong things, but regulators certainly were doing something. Expanding on this, we can look at court cases such as Fidance v. Harris, where case law was established with regards to ICO tokens and their classification. ICO, meaning initial coin offering, which is comparable to a traditional stock IPO, initial public offering, where shares of a company are sold on the open market. Recently, there has been a lot of discussion about contemporary cases such as the SEC versus Ripple or the SEC versus Library, but Fidance v. Harris is very often overlooked in that discussion. Simplified, it's obviously more complicated than this, but for the sake of time, I'll boil it down to the core premise. Fidance v. Harris established that an ICO, or at least the token offered during that process, was a security because it fulfilled all four prongs of the Howey test, which was established after a Supreme Court ruling with regards to SEC versus W.J. Howey on what is or is not an investment contract. Basically, the idea that crypto regulation does not have case law is effectively wrong. It might not be every ICO or every current token, but the vast majority of them, seriously, almost all of them, are easily defined as securities. And if we compare the token referenced in Fidance v. Harris, where a movie platform was created with a native token that allowed for viewers to watch, but was also designed specifically to increase in value as content was added to the platform, we can see that it has identical functionality, in a legal sense, to the FTT token from FTX. All of this is to say, again in very simple terms, that the SEC was never asleep at the wheel. They may have done less than they should have, or less than most of us think they should have, but governmental agencies have been closely monitoring and manipulating the world of crypto regulation for about 5 to 7 years. This requires a very specific question. To what end? Why have they done this? Why have they neglected certain aspects of regulation despite relatively clear case law? And why have they allowed this to happen when the results of that neglect are so damaging? Answer: because the government is creating their own crypto project called CBDC, or Central Bank Digital Currency, which will be just about as dystopian and authoritative as our feeble mortal brains can possibly even imagine. Here's the thing. This is not a new concept. Many figures in the crypto world have been warning about this for quite some time, but very rarely do they back up those ravings with anything other than, "Trust me, bro." Most of the time you will hear the idea of central bank digital currencies in a drug-fueled conspiracy rant, or inside a rambling tirade against the United States government. Perhaps true, perhaps not. You never even get the chance to evaluate things accurately because of the unhinged, unsubstantiated method by which they communicate with you. But today, I want to take some time and try to outline, from start to finish, where modern finance is about to go. To do this, I have to outline a series of administrative steps that occur when new laws are passed, because that process is what allows us a great deal of insight into what comes next. When a new law is passed, let's say something to do with securities or currency and regulation of that particular space, it starts with legislators. The first step towards regulation is the law itself, but after that it gets a whole lot more murky. Once a new law is passed, basically saying what to regulate, the process moves on to relevant agencies. These agencies, whichever ones happen to be the most relevant, such as the SEC or the CFTC, now create rules based on those laws, which have a significant degree of interpretation. Effectively, the law needs to be enforced, and defining how they are going to enforce that law is just as important as the actual law itself. During the period of time where agencies are composing these rules, let's call them, there is what's called a notice and comment period, where people, corporations, anyone really, can write in and comment on what the agency is putting forward. They actually want this. This is a big part of the process, often with specific questions asked by the agency to acquire feedback from interested parties. Well, it turns out that there have been not one, but two notice and comment periods already spurred by a presidential executive order pertaining to the adoption of a central bank digital currency by the US government. There are many different relevant sections to read here, but one of the most important ones seems to be a comment submitted by MasterCard, which effectively thanks the Federal Reserve for keeping in place a two-tiered system, which would effectively allow their business to continue operation. Quote, "We strongly concur with the Federal Reserve's view that provided the creation of a CBDC is determined to be warranted, an intermediated two-tier distribution model is preferable for the needs of the U.S. economy, as it preserves the role of financial intermediaries and payment service providers while utilizing existing resources." End quote. Basically, entrenched financial institutions with far-reaching political power are commenting that they support the implementation of a central bank digital currency because the current version of that idea is built in such a way as to continue supporting their business model. To me, that indicates that the idea is very serious and likely has almost no institutional barriers to cross whatsoever. Here's another comment, for example, from Liberty Bank, stressing the need for existing banks to be the only intermediaries between the Fed and American consumers/businesses. However, none of this really explains why the future of our financial system is dark or even grim. To explain that part of the puzzle, we need to go back to the official Federal Reserve notice about CBDCs, because that is where we find an extremely important detail. Quote, "While the Federal Reserve has made no decisions on whether to pursue or implement a central bank digital currency, or CBDC, we have been exploring the potential benefits and risks of CBDCs from a variety of angles, including through technological research and experimentation." End quote. That's interesting. They have made no decisions yet, allegedly, but still offered two separate notice and comment periods to the public, where major players in the United States financial economy came forward with ringing endorsements, which is very interesting. However, there's one more detail to examine, which reads as follows, quote, "As a liability of the Federal Reserve, however, a CBDC would be the safest digital asset available to the general public with no associated credit or liquidity risk." End quote. And that right there, ladies and gentlemen, is a bingo. This is important for one reason and one reason alone. Digital asset means that a central bank digital currency would not be a banknote, a reserve note, or a note of any kind, where note is a specific legal definition. Assets and notes are very different things. Digital assets fall under the classification of investment assets and are thus governed by a different set of rules, such as the ability to be access restricted for specific parties at any time. Right now, US dollars are technically classified as Federal Reserve notes, which are much less controlled. However, a central bank digital currency, defined as an asset instead of a note, would be open to a nearly unimaginable amount of control, far surpassing any monetary system we have ever seen in human history. Example, with all data flowing through the Federal Reserve on all transactions, and the currency classified as an asset instead of a note, they could place restrictions, as an example, easily on things like geographic location. This kind of control could mean that individuals they create parameters for, and they can create an untold number of parameters for anyone at any time, could be barred from spending money in certain states, or beyond a certain distance from their own home. And it can also mean that they set distinct parameters on how much central bank currency is even allowed to be held by individuals of the population at any given time. To demonstrate this, we can once again look at the second notice and comment period for central bank digital currency adoption, where financial analyst Michael Wozni says the following, quote, "It is not inconceivable that the amount of CBDC that can be held by a single consumer will become another tool in the Federal Reserve's arsenal to affect monetary policy. It would be natural to allow the Federal Reserve to vary this amount to affect monetary policy as it does currently with interest rates." End quote. Central bank digital currency would track every single transaction individuals make. It would be fully programmable and allow for nearly any rule set to be created within it, targeting criminals, persons of interest, political opposition, dissenters, conspiracy theorists, etc. This is where I will inevitably lose some of the more docile-minded viewers who think, yeah, so what, modern-day credit cards and digital transactions do the same thing, and the government would never do anything that bad to control the people. I don't buy it. Not true. And for those people, I have this. Jerome Powell, chairman of the Federal Reserve, stating that a United States central bank currency would not be anonymous.
We think that there are four characteristics of, if we were to pursue a CBDC, it would at a minimum have the following four characteristics. First is intermediated. Second is privacy protected. But third is identity verified. So it would not be anonymous. It would not be an anonymous bearer instrument. And fourth is transferable or interoperable. So we would be looking to balance privacy protection with identity verification, which has to be done, of course, in today's traditional banking system as well.
The word privacy here is critical because it's a sham. In the current financial system, you are protected from unlawful or unreasonable search and seizure by the Fourth Amendment, which specifically mentions papers. That's important because it therefore applies to banking records and other financial transactions that you make. Without reasonable cause, a court-certified search warrant, and a series of judicial benchmarks, your records cannot be taken, searched, or seized, but with a digital asset from the Federal Reserve, not a note, where all transaction data routes directly through them, you no longer have those protections. Remember the Bank Secrecy Act? FTX was being investigated for violations of the Bank Secrecy Act before it fell, but the rabbit hole of what that is and how it affects the future of central bank finance is far more troubling. The Bank Secrecy Act aims to curb terrorist activity and prevent money laundering. Noble causes, in theory, but after dramatic updates in a post-9/11 regulation world, the Bank Secrecy Act now provides far-reaching ability for the government to access financial records. If you combine this ability with a fully programmable central bank currency, what do you get? Answer, you get a monetary system where anyone that they brand as a person of interest, terrorist, or danger to the public can have their entire financial world immediately shut down completely. Once again, doe-eyed viewers with no common sense might think that's fine, that's a good thing, those people are bad anyway, but consider this. The right side of the political aisle, as in conservative Republicans in the United States, have, on occasion, attempted to brand Black Lives Matter and associated groups as a domestic terror organization. The left side of the political aisle has likewise attempted, on occasion, to brand the Make America Great Again MAGA movement as a different terrorist organization. And if either of those attempts were to be successful, while dominating policy in a central bank digital currency world, for whichever party was successful, it would mean that the Federal Reserve can unilaterally set entirely new guidelines for those groups to make it impossible for individuals to buy, sell, transact, or engage with almost any financial service in the country. That right there is a financial hellscape, but the world of fully controlled, non-anonymous central bank currencies is approaching faster than we think. The BIS Innovation Hub, an organization meant to foster collaboration between central banks around the world, is openly pursuing the concept of CBDCs. The New York Fed, in America, is running a 12-week pilot program with major banks. Japan is running a trial of their own, and so is Russia. In fact, dozens of countries around the world, more than that, with a supermajority of industrialized nations participating in this, are researching, developing, or currently piloting central bank digital currencies right now as I make the video. This is the intended future, a central, digital, highly trackable currency that is programmable for any set of rules that the government decides. And it's not a conspiracy theory, it's reality. On one side, major financial institutions support the concept because the government is making deliberate efforts to preserve their critical role in the process. But on the other, consumer advocacy and rights organizations are understandably appalled by what this could mean. In the second comment period that was opened, the National Consumer Law Center noted that the foundational control of this new currency model would mean that if the government dispersed unemployment payments to individuals, they could program those payments to be unusable for certain purchases. Quote, a government-issued CBDC would allow the government to dictate how, where, and when currency holders spend their funds. As an example, consider unemployment money issued in the form of a CBDC. The government could restrict the funds to not work at businesses categorized as liquor stores or bars. End quote. In essence, central bank digital currency would be an evolution on the Bank Secrecy Act to an unimaginable degree. CBDCs would be a method of population control unlike anything we have ever seen in history, And to make this possible, there need to be sweeping regulations of stablecoins and other crypto assets that currently exist to prevent competition and control market share. The prevailing narrative is that regulators were asleep at the wheel for FTX, but I would like to propose a different theory. Regulators knew what FTX was and simply allowed it to happen. The resulting devastation opens the door for extremely well-timed regulatory changes, while the underlying infrastructure has already been building, for quite a long time, on a government-controlled digital currency that will radically expand their control of population behavior, economic stability, and more. There's actually a ton more to go over here that I haven't even addressed, but the rabbit hole goes deeper than I care to risk exploring. For the sake of time and the fact that if I say the wrong thing on topics like this, I can quite literally be deplatformed, I'll cut it there. But the world of crypto was not blindsided by a lack of regulatory awareness. It was smashed open, wide open, by a useful idiot who ran a fraud scheme, back-channeled tens of millions of dollars to politicians, Democrat and Republican alike, and created an opening for one of the largest power grabs in human history to begin moving forward. The dark future of finance is a fully controllable, down to the individual person, central bank digital currency that circumvents the rights you currently enjoy. The Fourth Amendment, in particular, allows unparalleled control of a population and came about as a direct result of financial disaster that was not unseen or unknown, but rather allowed to happen as a sort of catalyst behind the new age of digital economies. Sure, some of this is speculation, but hopefully the evidence provided will serve as a thought-provoking look into the world of central bank digital currencies, which are poised to become a much greater part of our lives compared to what many people think. That's it. If you want to support, please check out the links down below. Remember, only 4 days left to get the limited edition holiday merch if you like the content. Also, Patreon and Locals, the video sponsor, social media, etc., etc. But I'll cut it there and stop rambling. As always, thank you all for watching, and have a nice night.